Very good morning, friends. So I hope everybody is doing good. And of course, your cumulative revision on financial instruments is on. You're almost now on the last leg of the standard and doing some kind of special issues in this particular standard. Our discussion was pertaining to the concept of derecognition of financial assets. And we yet to do two small agendas of discussions on derecognition of financial assets. And then we go to the derecognition of financial liabilities also today. So the agenda is, after the concept of derecognition is done, I am going to take you forward in terms of the concept of hedging, which is a very interesting input given in India's 109. So just to remind you, when we were talking in terms of derecognition of financial assets, I give you a three-step model in which we decided the step number 1, A, B, C. Typically, the cash flow test. The step number 2 is the risk and reward test. And if the need be, we go to the step 3, that is a control test. In terms of step number 1A, the focus is the cash flows have expired or not. In terms of step number 1B, the focus is are they transferred or not. And in terms of step number 1C, the concept is whether it is a PTA, a pass-through arrangement. Now, this is what we are still left to discuss, that when do we say that it is a pass-through arrangement, which I am going to walk through and also do the conditions and the illustration on that. That is one agenda. Second, if you remember, I said before you apply this three-step model, you need to zero down on the fact whether a derecognition is done for an entire financial asset or is it to be done for a part of the financial asset, where I give you little references in terms of the interest and the principal strip. So we've got two areas of discussions pending. One is the concept of a PTA. When do you say that it is a pass-through arrangement? And then we need to discuss whether derecognition is done for a part of the asset or for the entire asset. Then after that, we are going to go to the concept of derecognition of financial liability. So let me start the journey in terms of PTA. Now watch this carefully. I'm just going to give you a simple, diagrammatic view so that we can understand what is a pass-through arrangement with a little diagrammatic position. So I'm just going to take a little inputs at this stage. Watch this carefully. We'll look at an example as well to see how does it actually operate. Now imagine on one side there is a company A Limited, which is what it does. It pools, you can say, a lot of financial assets. And after pooling these financial assets, it creates what is called a trust. It creates what is called a trust. Now, what it does, it basically tells the trust that you find out some investors who can, invest in my company, but not directly with me. So what the trust does, it approaches in the market certain unrelated investor. They approach in the market certain unrelated investors. Now let's look at the sequence of what is done in this particular arrangement. The trust is acting like, you can say, a special purpose vehicle, what we call an SPV, and the intermediate acts as an intermediary in this particular stage. So what it does, its job is basically to approach the unrelated investor and issue securities to them. So what the trust will do, it will basically issue securities to these unrelated investors. So once these securities are issued to these unrelated investors, then the money which he gets from the unrelated investor is going to be passed on to the company. So he issues the security and the unrelated investor basically, pays cash on account of investment in the security. So the arrangement between the trust and the company A Limited is that the trust is acting as an intermediary arranging the funds. So he is going to basically issue the securities to these unrelated investors and they will pay the money, and this money, which the cash received is concerned, is going to be given to the company A Limited. Now, another question which comes into the mind is, why would an unrelated investor, rely upon, you can say, a trust, which is a newly formed trust, a SPV? So the trust actually tells these unrelated investors that I am backed up by a company which is A Limited, which has pooled all the financial assets, and he says what I am basically, get the entire cash flows, and I will get the cash flows and I'll transfer the cash flows to you. So these cash flows are also transferred towards the unrelated investor. So this is how the cycle actually operates if we have a very simple diagrammatic view in terms of how this entire function works. This is called a pass-through arrangement because you are basically passing the cash flows through a trust, and therefore it is called a PTA. Now you would start asking questions in terms of what is the good point in terms of entering this kind of an SPV. Well, there could be a lot of considerations in terms of taxations and other aspects as well. So I'll not get into why people create this kind of arrangements. But the step number 1B which we did was a case of a direct transfer. And this you can say is a case of an indirect transfer, where you can see that the trust is only acting as an intermediary. At the end of the day, A is getting money from these unrelated investors through the trust, and A is passing on the cash flows of the financial assets to the unrelated investor. So the trust is only acting as an intermediary, passing on the cash flows and passing on the cash received from the unrelated investor. Now, in terms of Ind AS 109, this kind of arrangement, as we've already said, is a pass-through arrangement. But the standard setters decided we don't have a problem if you put an intermediary in between. But at the end of the day, do we consider this kind of an arrangement as good as a transfer? Do we allow the company that, yes, this is a transfer, let's now evaluate a risk and reward test and decide whether a derecognition is done or not? So what the standard did, in order to call it as a transfer, they laid down a total of 3 conditions. We'll come to those conditions very shortly. So they laid down a total of, you can say, 3 conditions. And if all these conditions are met, then in that particular case, I would say we're ready to go to the step number 2, that is a risk and reward test. I'm making a reference to the 3-step model, which we've discussed in the previous class. So this is like the step number 1C. When you look at the pass-through arrangement, this is like looking at step number 1C. That if it is a pass-through arrangement meeting the 3 conditions, then I will go to the step number 2, risk and reward. But let's say if any one or more is met, if any one or more fails, if any one or more condition in this particular case fails, then in this particular case, you need to continue the asset in the books of accounts. A derecognition cannot take place. So I think let me just consolidate the picture at this particular stage. So we're looking at the focus in terms of step number 1C out of the 3-step model, which is called a PTA, that's called a pass-through arrangement. So what we do in terms of a pass-through arrangement is you create an intermediary, a trust in between. So what happens in this particular case, A Limited pools of financial assets, and he tells the trust, you organize some unrelated investors, issue them securities, get the money, and pass the money to me. Now, what do the unrelated investors get in return? The unrelated investors will get all the cash flows which are coming out of the pool of financial assets, because A Limited tells the trust that I will transfer the cash flows to you, and all the cash flows will be given to the unrelated investor. So indirectly, the unrelated investors are getting the cash flows out of the pooled financial assets, and the unrelated investors are giving money to the company A Limited, and all this is happening through a trust. And in this particular case, it is as good as a transfer, provided we are able to meet three conditions which are given in the standard. You fail any one or more of the conditions, the asset will continue in the books of accounts. And in this particular case, if you meet all the conditions, then it is considered to be a transfer. You can go to step 2, which is a risk and reward test. I hope, friends, I have made myself clear on the basic structure of the PTA. Okay, now let's do one thing. There is an illustration which is given in the study mat, and this is illustration number 6. I'm coming to the illustration number 6, which elaborates the inputs as far as the pass-through arrangement is concerned. But I think we also need to look at, first of all, the conditions as well. Oh my God. Whenever I do something technical indeed, I generally see, my board sometimes gives me that this is getting technical. Okay, so let me just come back on the agenda. So I am going to look at the inputs in terms of the three conditions as well. So let me, I think, first of all, read the illustration to you, and then we are going to look at those conditions as well. So as I read, I will explain the conditions as well. Some of the conditions are very straightforward indeed. Now, first of all, let's read illustration 6. It says entity A makes a 5-year interest-bearing loan that is the original asset of 100 crores to entity B. So we can say entity A has given a loan to entity B. So this particular loan is supposed to be a financial asset for the entity A. So A has given a loan to B, and this is a financial asset to company A. It says A settles a trust, that means creates a trust and transfers the loan to that trust. So we can very clearly see that what is being done, that A is creating a trust, and after he creates a trust, he is approaching certain investors as well. So it says the trust issues the participatory notes to an investor, that is entity C. So they've given the name of this investor, that is C. So A is creating a trust and passing on the cash flows. So the trust is going to issue securities to C that entitles the investors to the cash flows from the asset. So I think the para number 1 is very clearly indicative that it is a pass-through arrangement in which the entity A is creating a trust in between, and he's approaching an unrelated investor C, and the cash flows are being transferred. As per the trust agreement with entity C, in exchange for a cash payment of 90 crores, though the original value of the asset is 100 crores, but he is getting a cash payment of 90 crores, the trust will pass to the entity C 90% of all the principal and the interest payment collected from entity B as and when and if collected. As and if collected. So one of the conditions which is given is that as far as the trust is concerned, he will pass on the cash without any material delay. That's one of the conditions, that what is the job of the trust when the cash flows from the financial assets will arise. The trust is responsible. The language used in the standard is that he needs to transfer the cash flows without any material delay. Don't worry, I'll pen down those conditions later. Now, what is a material delay is nowhere defined in the standard, but we understand that it should be, on an immediate basis. There could be like 2-3 days or whatever, but that's not given in the standard. It only says that without any material delay, there needs to be a transfer. That is one condition. And it says as and when if collected. So condition number 1 is that you need to transfer the cash flows without a material delay. And the second condition is that you need to transfer all the cash flows which will arise out of that particular asset. So in this particular case, you need to transfer the cash flows and whatever comes. Like for example, if A is not getting certain cash flow, there is a possibility of a bad debts, then the risk is indirectly of C. So he will say that I will pass on only what comes. I will not pass on what doesn't come. So you are going to bear the risk. If the cash flows comes, it's your luck. If the cash flows don't come, it's your luck. So he says, I will transfer whatever comes. And he is not giving any kind of guarantee in terms of any extra cash flow. He says, I will pass on what comes in. I'm not going to give you a guarantee in terms of the entire cash flow. What comes is given to you, condition one. What comes is given to you without a material delay, that's condition two. So it says the trust accepts no obligation to make any payments to entity C other than 90% of exactly what has been received from entity B. So that is the condition number two. The first condition we've already seen is supposed to be as and when collected. So he says without material delay, I'll pass on the cash flow. He says in this particular case, I am under no obligations to give you anything extra. Whatever comes will be given to you. Then he says the trust provides no guarantee to entity C, extension of the condition 2 only, about the performance of the loan and has got no rights to retain 90% of the cash collected, nor any obligation to pay the cash to C if the cash is not received. He says, I am not responsible if the cash is not collected. I cannot pass on to you. And there is a third condition as well, that in this case, the originating entity, that is entity A, in this particular case, the entity A in this particular case cannot pledge the asset. He will not be in a position to pledge this asset in any other transaction. So what are the three conditions to call it as a case of transfer? Condition number one, the trust is telling the unrelated investor, that is C, I give you what comes. No guarantee for anything extra. He says, I'll give you the transfer without any material delay. And the condition number three is that the company A, the originator, cannot pledge any of these assets. So if all these three conditions are met, we would say it is a PTA. Though in this example, we are not given whether he can pledge or not, but that's being assumed that he cannot pledge the asset. So if the three conditions which I gave you are met, the proportion sold is derecognized. It says the proportion sold. The reason why it's saying proportion sold is I did not transfer the entire asset. I transferred only 90% of the cash flows to the trust and to the unrelated investor. So it is not a derecognition of the entire asset, but it is a derecognition of a part of the asset in this particular case. Provided the entity has transferred substantially all the risk and reward. So once the cash flow test is met, you need to meet the risk and reward test as well. Thus, A would report a loan asset of 10 crores and he would derecognize 90 crores. As I said, it is a case of a transfer of the part of the asset. Therefore, 10 crores of asset will continue in the books of accounts. The derecognition principles are applied only to 90% of the asset. The book value of the loan is appearing at 100 crores, but only 90% cash flows transferred. So derecognition will be done for 90%, that is 90 crores. So I think let's now pen down the conditions of a PTA, that is a pass-through arrangement. I think let's make some notes to you at this stage. So I'm just going to add some inputs at this particular stage as far as the conditions, the three conditions of PTA is concerned. So let's see what are the three parameters in terms of a pass-through arrangement. Once the conditions are met, it is a PTA, you're ready to go to the risk and reward test. So we can say the condition number one is cash flows are to be transferred. Cash flows are to be transferred without any material delay. That's the language used. So the language used in the standard is without any material delay. So as I said earlier, this is nowhere defined in the standard. What do you mean by a material delay? But it is understandable that it should be transferred on an immediate basis. We should not stop the money. The second condition which we need to see is only cash flows which are received, only cash flows which are received in the example from entity B, are transferred to the trust, by entity A. I'm taking the same example to illustrate the condition. So only the cash flows which are received from B are transferred to the trust by entity A. Thus, the trust is under no obligation. Thus, the trust is under no obligation. So the trust is under no obligation to transfer, rather I would say is under no obligation to guarantee any extra cash flows. What comes is given without any material delay. So the first condition is without a delay. The second is what comes is given. And the third condition is the financial asset cannot be pledged. The financial asset cannot be pledged by entity A. So he cannot pledge the assets. Once he enters into this kind of an arrangement, he cannot pledge the assets. That is another third condition. Right, friends, I hope I am now pretty clear in terms of the three conditions and the concept of a PTA. This was one issue which was pending out of the discussion in terms of step number 1C, that what is the PTA and what are the conditions which would qualify that it is a case of cash flow transfer. So far, so good, I guess. Okay, now comes another agenda of discussion, and that was derecognition is applied to a part or derecognition is applied to entire asset as well. Now, this is tricky. This is what I'm discussing in the morning is going to be a little tricky indeed. So hear me carefully. So I am now going to take you to the illustration number 4, which is explaining the agenda of a part transfer. Now this is technical, so please hear me very carefully. You might get a little confused as I read the language. If you remember in the last session, I had given you the inputs that before you apply the 3-step model, the derecognition principle, you need to basically decide, are we applying this to an entire asset or are we applying this to a part of the asset? So let me just remind the basic inputs to you. So what I gave you, that if you look at a loan, for example, let's say in my books of accounts, I have a loan which is a financial asset. Now, if you look at the cash flow streams which can arise out of this asset, I would say there are two cash flow streams. One is the right to receive the interest, that is called the interest strip. And one is the right to receive the principal, and which is called a principal strip. So as a holder of the financial asset, I may transfer the rights of the principal only. I may transfer the rights of the interest only. Or I may transfer the right to the interest and principal, may not be fully. But like, for example, we just saw in illustration 6 that the company A transferred 90% of the cash flow, which means I may agree to transfer 100% principal or 100% interest, or I may transfer 90% of the interest and the principal. So the standard gives us the parameters to decide when would you say that yes, it is a part transfer. So you would derecognize only a part of the asset and the remaining part will continue in the books of accounts. So we're coming now to the agenda, that what are the basic principles which will tell you that derecognition can be done for a part or derecognition is done in entirety. So let me just come to the inputs first. The question is given, but I'm going to first read the answer. Illustration 4 is given, but I'm going to first read the answer because the answer is telling you the conditions when a derecognition can take place for a part of the asset. So we're going to read the question later, but we're first reading the answer. Let's, I think, read. It says in terms of derecognition requirements are applied to a part of the financial asset if that part meets any of the following three conditions. You don't need to meet all the conditions. You need to meet any one of the three conditions. One of the three conditions is met, a derecognition can be done for a part of the financial asset. Now let's look at the three conditions. Condition A. The part comprises of specifically identified cash flows. The word used is specifically identified cash flow. You specifically identify the principal. You specifically identify the interest. So that is called specifically identified. So either the principal or the interest, mind my words, either the principal or the interest. So the part comprises of specifically identified cash flows. For example, an entity enters into an interest rate strip whereby the counterparty obtains the right to the interest cash flows but not to the principal cash flows from a debt instrument. So you're saying that I will transfer the rights to principal only, or I will give you the right to the interest only, either interest or principal, but fool. Mind it. It says the condition number one is you transfer either interest or principal, but 100%. So condition number A is not considering that you transfer 80% of the principal. No, you transfer 100% principal or 100% interest, but not both. But what is important is 100%. Don't worry, I'll document that. Next condition. It says the part comprises of fully proportionate pro rata share of the cash flows. It's a pro rata share of the cash flows. Now, when I say pro rata share of the cash flow, it is like 80% interest, 80% principal. 90% interest, 90% interest. It is to be equal percentage of both interest and principal. Mind the words. I'm saying it is 80% of both the principal and the interest. It cannot be a different percentage. It is not 100%. So when you say that it is fully proportionate pro rata share of the cash flow, that means both principal interest but equal percentages but not 100%. So you need to transfer the principal also, the interest also, and that also equal percentage, but not 100%. Let's see. For example, when an entity enters into the arrangement where the counterparty gets the right 90% of all the cash flows. All the cash flow means 90% of the principal and 90% of the interest. So the focus in the condition number one is either principal or interest 100%. The focus in terms of the condition number two is both the principal and the interest equal percentages. You cannot have unequal percentages and not 100% either. Then he says the part comprises of fully proportionate, same language, pro rata share of the specifically identified cash flows. It is specifically identified cash flow, which means in this particular case, you identify interest strip only 80%, not full. You transfer the principal strip only 80%. So what is the difference between A and C? In terms of A, 100% interest or 100% principal. In terms of C, 80% interest only or 80% principal. One of them, but not 100%. In condition number A, it is one of them 100%. In condition number C, it is one of them, but only below 100%. And what is there in B? Both of them equal percentage. So in this particular case, I guess we can also see the example for the condition number this C as well. So let's have a look at the condition number C as well. And in terms of C, it says, for example, when the entity transfers 90% of the interest cash flow from the financial assets. So it is going to be a case of either interest or either principal less than 100%. So moral of the story, let me make it very clear to you before we go to the illustration number 4. So when I'm looking in terms of the derecognition principle, whether we need to apply the derecognition principle to the part or whether we need to apply the derecognition principle to the entire financial asset. Now watch this carefully. I'm going to just summarize the inputs in terms of any one condition is met. Any one condition is met. So you need to meet any one condition. You need to meet any one condition out of the 3 conditions which are given. So let's see what are the 3 conditions. Let's see this very carefully. So it's just a matter of language and a clarity of thought. So the condition number 1 is you transfer either interest or principal strip. So this is you transfer either the interest strip. So either you transfer the interest portion, that is called interest strip, or we can say you transfer the principal strip. So this is condition 1. You transfer either the interest or the principal strip in this case, and 100%. And what is important in this case is that it is transferred either of them, but you transfer either 100% interest or you transfer 100% principal. That is one condition. One of the two, दोनों में से एक पूरा, दोनों में से एक पूरा. Then you look at the other one. In this case also we are saying it's either. It is either the interest strip. So you transfer either the interest strip or you transfer either the principal strip. One of the two. But what is the difference between the first and the third one is what we need to watch out. And in this particular case, we are saying it is below 100%, not 100%, but below 100%. Either the interest strip below 100 or the principal strip below 100, one of the two. One of the two. That's what you need to get clear on. So this is one of the two fully, and this is one of the two, you can say pro rata. And then comes this case, we can say you transfer both. You transfer both. The focus is now on both, not either of the two. You transfer both the interest strip as well as the principal strip. So we're putting it as and. So let me just on a very safe side also put it as a plus. So you transfer the interest and the principal strip both. And in this particular case, when you transfer them, in this case, it is not 100%. It is not 100%, but below 100%. That is the essence. So you transfer below 100%, not fully. So, but it is below 100%, but equal percentages, that is important. 80% interest, 80% principal, 70% interest, 70% principal. That is the essence. So these are the principles which are given in the standard that if you want to derecognize a part of the asset, you either transfer one of the two fully, or you transfer one of the two disproportionately, or you transfer both, but you transfer equal percentage below 100%. I hope, friends, I'm very clear on the decision part or entire asset. Correct? Okay, so far so good. I think we can now have a look at the illustration number 4 on this particular case. So let's have a look at illustration 4, and I think you can do a similar illustration 5 on the same lines. And let's see the illustration number 4. State whether derecognition principles will be applied or not. Interest strip of an interest-bearing financial asset, that is the part entitles the holder to the interest cash flows. I am transferring the interest strip only. Yes, the derecognition can take place for a part of the asset in this case because you are falling in condition number A. You are transferring one of the two fully, so it is identified, specifically identified cash flow. It says a dividend strip of an equity share, that is the part entitles the holder to only dividends arising from equity share. So this is again only a part of the asset. You transferred only the dividend strip, and that means it is fully one of the two, not the principal, just the return. So it is again a derecognition of a part. Then he says the cash flows, that is principal and the asset, up to a certain tenure or a first right on the proportion of the cash flow. Now, you cannot have these ifs and buts. For a derecognition of the part of the asset, you cannot put ifs and buts. I'll give you the first cash flows. I will give you only the first right, etc. Not allowed. Then derecognition will be full. It says, say the part entitles the holder to the first 80% of the cash flows or for the first 4 out of 6 years of tenure. This cannot be a case of a part of the asset. You need to derecognize it entirely, fully. So if you meet any one of the three conditions, a part derecognition can be done. If the conditions are not met, then a full derecognition will be applied. The derecognition principles will be applied to full. Let me caution that when you're looking at a part, you're saying, let me apply the derecognition principle to the part. That is, apply the three-step model to the part. And when you say that if the conditions are not met, you apply the derecognition principles to the full part, to the full asset. So we're not saying that you will derecognize the asset fully. You need to apply the derecognition principle. You need to apply the three-step model to the entire asset in this particular case and see if they're fulfilled, whether I can derecognize the asset or not. I hope you got the point. Which means that if I now try to look at the entire picture, just a little quick inputs at this stage, let me now give you input. One input, of course, I've intentionally not covered so far because we don't know about consolidation. But at this particular stage, I would just like to add one basic inputs at this stage. So I would just like to add one quick inputs at this stage. If I were to summarize, I give you a quick summary of the derecognition principles. Now let's make the position clear. What kind of questions can be asked in this entire framework of derecognitions now? So when you're looking at a summary in terms of derecognition of a financial asset, now what is the first thing? Your first thing is you need to put across a question. As I said earlier as well, the first thing is you need to put across a question. And the question which you need to put across is, do we apply derecognition principles? Do we apply the derecognition principles? And what are the derecognition principles? That is the three-step model which we discussed. So do we apply the derecognition principle? That is the three-step model which I gave you. So the first question is, do we apply the derecognition principles to part or entire financial asset? You need to decide, do we apply the derecognition principles to the part of the asset or to the entire financial asset? So that is the first stage. The derecognition principle is to be applied to what? A full asset, or is it a part of the asset? And for this particular purpose, what do you need to do? You need to meet any one of the conditions, any one out of three conditions. So you need to meet any one of the three conditions which I gave you, that you are transferring one of the two fully, or both of them equal percentage below 100, or you are going to transfer one of the two, you can say below 100. So we can say the three conditions which I gave you in this particular stage is, to put it in a very simplified manner, we can say that you transfer any one, principal or interest, 100%, or you transfer any one, and in this case it is below 100%. It is below 100%, that will also work. Or we can say you transfer both. You transfer both, but it is going to be equal percentage and below 100%. It is equal percentage, but it is below 100%. You meet any one of them, the derecognition principles will be applied to the part of the asset. Otherwise, it will be applied to the full asset. That is one agenda. This, what we have covered in this particular case. I have covered in this case the illustration number 4. And you can do the illustration 5, which is given in the study mat, which is devoted only to this particular aspect. Now, after you've zeroed down that I'm going to apply the derecognition principle to the entire asset or to the part of the asset, then you proceed further. And then you apply a simple 3-step model. And when you apply the 3-step model, we know that the first step is in terms of what we call the cash flow test. And in terms of the cash flow test, now you know what is expired, now you know what is transferred, and you also know what is a PTA. So either tell me it is expired, or tell me it is transferred, or tell me it is a PTA. And in this particular case, what we covered in terms of this, the illustration number 6 of the study material is devoted to the concept of explaining you what is a pass-through arrangement. And then you go to the step number 2 and apply a risk and reward test in this particular case. And in terms of the risk and reward test, I have given you a total of 4 charts already, where I give you the concept of repurchase agreements, a call options, a put options, etc. So in order to explain this, I've given you a total of 4 charts in the last class, where I gave you the inputs of deciding how the risk and reward is substantially transferred, substantially retained, or is it a case of neither. And if you look at in the study material, I would say in this particular case, the illustration which is devoted, illustration 7, 8, 9, and 10, is devoted to the concept of risk and reward test only. 1 illustration on the cash flow test and 4 illustrations on the risk and reward test. And then comes the element in terms of the step number 3, where you're applying the control test. There is no illustration, but there were 2 small examples, if you remember, in the study material, explaining the practical ability to deal with the financial asset. So in the study material, there were 2 examples, 1 and 2, which was explaining you the concept of a practical ability. So this is like stage 1, derecognition part or full. This is stage 2, applying the derecognition principle. And then comes the stage number 3, which is accounting. So we decided after this particular aspect, I think let me just take the chain further. And then we decided after you applied the derecognition principles, then the stage 3 comes that you're applying the accounting as well. And I've already given you that there are 3 kinds of accountings which are applied. The accounting is again into 3 types. Either it is a case of a full derecognition, or it is a case of a no derecognition, or it is a case of what we call a partial derecognition. And we call the concept of a partial derecognition as a continuing involvement approach as well. So the standard is explained to you in the study material that stage 1 is, do we apply the derecognition to part of full? Once you've decided that, what are the derecognition principles, stage 2, and the stage 3 is the accounting. And in terms of full derecognition, we've already seen that you are going to pass an entry that is bank account gets a debit and financial asset gets a credit, and the balancing figure is gain or loss in the P&L. When there is no derecognition, in this particular case, you put the entry bank account debit and the financial liability gets a credit. So here there is a balancing figure which enters the P&L. And when it is a case of a partial derecognition, you are basically putting the entry bank gets a debit, financial asset gets a credit, and then continuing involvement asset gets a debit, associated liability gets a credit. So it is a merger of this, and you can say the second entry, and any balancing figure in this entry is again taken to the P&L, the profit loss on derecognitions. And if you look at the mapping in terms of the questions which are given in the study, so on full derecognition, there is an illustration number 10 which is devoted. I think illustration 10 or 11, I guess. This was 10, sorry, 11. So there is an illustration number 11 which is devoted to the concept of a full derecognition. There is no question on no derecognition. And then on the partial derecognition, you can see in the study material, illustration number 12A to 12C is devoted. This is how the entire chain has been discussed in the study material. If you get the focus clear, you'll be able to revise it well. Derecognition to be applied to part or entire. Then what are the derecognition principle, the three-step model, and then the accounting for derecognitions, and there are three kinds of derecognition. I am now done with the concept of derecognitions of the financial assets with you. I know it is technical, but at the same time, I hope and trust that you've got the basic framework very clear. Yes or no? Tell me, then I'll take the journey forward with you. Okay, so far so good, I guess. Let me now take the inputs. Yes, Nikhil, that's great. Okay. Now what I am going to do further with you in this particular case, we're now going to go to the inputs on derecognition of financial liability, which is not very technical as compared to this one, but yes, it is interesting indeed. So let me now come to the inputs in terms of derecognitions of financial liability. Now watch this carefully, because this is one area which has come in the exams also, and it's very simple, but involves a little computations in this particular case. Just to remind you, when you say a derecognition of financial liability, it is like a removal of the financial liability from the balance sheet, or you can say the books of accounts. Now, in this particular case, there is an interesting discussion which is done as a part of the derecognition, and that is called debt restructuring. It is basically called SDR. I'll explain what is SDR, or a debt restructuring. Let's say, for example, I have taken a loan from a bank, and that amount is, let's say, a financial liability for me. Now, I'm contractually obliged to pay interest to my bankers, and I'm also obliged to pay the principal, let's say at regular intervals, or let's say there is one bullet payment, whatever. Now, what happens is that I am under a lot of financial constraints, and I'm unable to pay the interest or the principal obligations to the banker. So I approach the banker and I tell them, sir, can you please accommodate me, because I'm under financial stress. And because of the financial stress, I am not having any malified intentions. It's not that I won't pay your money, but can you give me some kind of help and, restructure my debt? That is called restructuring. You would have seen many times in newspapers as well. Like, for example, recently also you would have heard, banks like ICAI, they are acceding to the request of the industry and they're trying to restructure the debt. So which means there is a renegotiation which happens when I have taken a loan and I'm unable to pay the bankers, and I request them to restructure the terms and conditions of the loan. So what we're going to do in terms of derecognition is we are going to specifically talk about restructuring of those debts. That is called SDR, that is called strategic debt restructuring. So in the study material, there has been two examples specifically, which has been given explaining that how does the accounting for restructuring of the debt takes place, which is a financial liability. So I've got basically given you a basic background of what we are discussing. Now let's read. It says many times the entities would renegotiate the terms of their existing debts with the lender. In India, this is called popularly SDR, that is called strategic debt restructuring. So we're looking at those financial liability which you already owe to the outsiders, and you are requesting them to renegotiate because of your financial stress. Sometimes entity approach the lenders to renegotiate the terms of the debt when they want to take advantage of the falling interest rate regime as well. In accounting terms, such situations need to be evaluated to determine whether the original debt is extinguished or not. Let me explain. So the standard makes it very clear that if you are renegotiating a debt with your lender, in this particular case, we need to apply certain materiality test. And we need to see on the basis of materiality test whether we will apply what is called extinguishment accounting or whether we are going to apply what is called a modification accounting. So there are two kinds of accounting which has been suggested on the basis of materiality test. That materiality test is what I called a 10% test. So at the first instance, if you see a borrower negotiating with a lender, you need to first of all evaluate the inputs, apply a 10% test, materiality test, and see whether we apply an extinguishment accounting or a modification accounting. Now at this stage, let's not get worried that what is an extinguishment accounting or what is a modification accounting. But I can tell you one thing. When I say that we're going to apply an extinguishment accounting, it means removal of the existing liability from the books of accounts and creating a new liability in the books of accounts. That is called an extinguishment accounting. But if you're looking at the case of what we call a modification accounting, it is continuing the liability in the books of accounts. There is no removal of the financial liability out of the books of accounts. So which means in a given question, when I am given a renegotiation between the borrower and lender, your first step is applying a materiality test. That is called a 10% test. And in this 10% test, to keep your life simple, I'm going to again create a 3-step model. Oh, sir, not again. So to make your life simple, we're going to apply a 3-step model in terms of the materiality test. The materiality test is not giving you any accounting. It is only telling you the kind of accounting to be applied. So depending upon the test, you will decide whether it is modification or it is extinguishment accounting. Let's see. So in this particular case, we are given that, I think let's come directly out here. So we can say this is like step number 1. The materiality test, this is like step number 1, and this is like step number 2. And this is like the step number 3. So you need to apply a 3 steps in terms of what I call the materiality test. I call it as a materiality test, or you can even call this as a 10% test because the parameters are checking a 10% test. In fact, if you remember, even in terms of Ind AS 108, when you identify an operating segments, reportable segments, you apply a materiality test of 10%. So even in this case, a 10% test is being suggested. Now let's see what are the 3 steps to be applied. In step number 1, you need to calculate a present value of the cash flows based on the new terms, including any fees which you might have to pay. Or let's put it like this, that you will take the entire cash flow based on the new terms, including the TC, that is a transaction cost. But all this will be discounted using the original effective interest rate only. So what I'm going to basically do, I will say, okay, as per the renegotiated deal, can you tell me what are the cash flows? And let me discount those cash flows based on the original EIR only. And then step number 2, You need to calculate the discounted present value of the remaining cash flows based on the original terms using the same original EIR. So one thing which you need to be clear on is that I will calculate the present value of the new cash flows at original EIR. I will calculate the present value of the existing cash flows, which is remaining cash flows based on the original EIR. So the discounting rate which is used in step 1 and 2 is common. So we're basically looking at the differences in terms of the timing factor of the cash flow. Because in step 1 you will discount the new cash flows, in step 2 you will discount the original cash flows, and you're discounting at the same rate. So the variation in answer is only because of the timing factor of the cash flow, because discounting rate is common. And then in step number 3, we will express the step 1 and 2 difference as a percentage. You will take the difference between 2 and 1. So we will take the difference between step number 2 figure and the step number 1 figure. So we will see what is the difference between the step 2 and 1 and express this as a percentage and see the percentage. What is the variation? If the variation is greater than or equal to 10% or not, is greater than or is it equal to 10? So if it is 10% or more than 10%, I said 10% or more than 10%, we will apply extinguishment accounting. And if it is supposed to be below 10%, then we apply what is called modification accounting. So these 3 steps will only tell you that which kind of accounting would apply. If your percentage of differences is 10% or more than 10, extinguishment accounting. I will remove the old liability and create a new liability in the books. So this is also summarized out here. So if you look at the materiality test which has been conducted, so once you decide, yes, there is a substantial modification. What is substantial modification? That the materiality test is 10% or more. So if you say yes, there is a substantial modification in terms of the new terms, you need to apply an extinguishment accounting. And if you say no, it is not substantial, that means the materiality test tells me it is below 10%, you need to apply what is called a modification accounting. So how do we apply these 3 steps? We will see in a practical illustration, but let's get one chain very clear. Don't worry, I'll pen down the notes also very soon. So what I need to do, first of all, if I am renegotiating with a banker, I am renegotiating with my lender, I will sit down and apply a materiality test, which is called a 10% test. They don't call it as a 10% test in the standard. I call it for convenience. In this particular case, I will first of all calculate the present value of the cash flows based on the new terms. And then I will calculate the present value of the remaining cash flows based on original terms, both using original EIR. And then I will look at the percentage variation. If the variation is 10% or more than 10, extinguishment, remove the existing liability from the books. And if it is below 10%, then it is modification accounting. Now, how extinguishment accounting would apply or how modification accounting will apply, that we will see in a practical illustration. I hope, friends, you got the map clear in terms of the thought process, right? Let's take the journey further. So I'm just going to first make some notes documented to you. Let me, I think, make some notes at this stage. So what we're looking at now is the concept of derecognition of financial liabilities. My focus now is derecognition of financial liability. And when I'm looking at a derecognition of financial liability, in this particular case, my focus is on what we call SDR. That is called strategic debt restructuring. That is called strategic debt restructuring. So within this concept of derecognition, we are focusing on a debt restructuring, which is renegotiating the terms of the loan with the lender. So what is SDR? It is basically renegotiation of terms with the lender. So we are basically renegotiating the terms with the lender because in this particular case, we may not be able to pay money. We are under financial stress and we request him that please renegotiate. So what we need to do, we can say the type of accounting to be applied, depends upon materiality test. So it depends upon what we call the materiality test, and that's what I call it as a 10% test. So let me put this in the brackets. We call this as a 10% test. So what kind of accounting would apply would depend upon a 10% test. So we will apply the step number 1. Now what do we need to do in step number 1? We need to calculate the present value of, you can say, new cash flows. We need to consider the present value of new cash flows, and we also need to add the TC as well. So we will take the present value of all the new cash flows, including the TC. Then in terms of the step number 2, we need to calculate the present value of the remaining, we need to consider the remaining original cash flows. So we need to consider the present value of the remaining cash flows, and both these present values are at the original effective interest rate only. So we're going to see what was the original decided EIR. So we're just looking at the variations in terms of, you can say, the pattern of the cash flows. And then in terms of step number 3, we will calculate a percentage. We need to compute the percentage variation. Difference between the two steps, express this as a percentage. And this percentage variation would decide the agenda if it is 10% or more. If the variation is 10% or more, we will apply what is called extinguishment accounting. We will apply what is called an extinguishment accounting. And if it is supposed to be below 10%, we are saying below, not 10. If it is below 10%, we will apply what is called a modification accounting. So in this particular case, we'll apply a modification accounting. Right, so this is the derecognition. We can say the SDR. This will only decide the fate of the accounting, mind you. This will only decide the fate of the accounting. So materiality will only decide what kind of accounting is done. How extinguishment or how modification accounting is done, that we'll see in a practical illustration with you. Okay, let's begin the journey. I am now going to take you further. So there is 2 examples in the study material. Example number 3 on extinguishment accounting, and example number 4, which is on a modification accounting. So we're going to look at the example 3, which is on extinguishment accounting. Okay, so let me now make a walkthrough very carefully with you, because the calculations are not very extensive, but we need to understand the larger concept. So hear me carefully. I'll first explain the 10% test, then explain the extinguishment accounting in this example. In the next one also, I'll explain the 10% test and then explain the modification accounting. It says in example number 3, on 1st January X0, XYZ issued a 10-year bond for 10 lakhs, bearing an interest rate of 10% payable on December each year, and the bonds are redeemable on December X9. No cost or fees is incurred. No cost means no TC. No fees means no processing fee. No TC, no processing fee. Aha. The CR is equal to the EIR. It says the effective interest rate is therefore 10%. So he's very clearly given you the coupon rate, or you can say the contracted rate, is 10%. Since there is no TC involved, since there is no processing fees involved, the effective interest rate is also at the rate of 10%. We've seen these things earlier. Then he says on 1st January X5, that is after 5 years, XYZ and the bondholders agree to a modification in accordance with the following. They've sat down and done some renegotiations on the deal. The term is extended to December Y1. Be careful with the dates, December Y1. Now, what you need to do in this particular case, if you notice in this particular case, originally the term was January X0 ending on January X9. X9. Now we are extending the terms to Y1. So after X9 will be Y0 and then it will be Y1. So originally the term was decided to be 10 years. And now it is got extended to 20Y1. That means it got extended by another 2 years. So we can say the negotiation happened after 5 years. So out of 10 years, 5 years is over. So they decided that we will extend the deal to another 2 years, which means now the remaining tenure is 7 years because Y1. So it says the term is extended to December Y1, interest payments reduced to 5% from 10%, and the bonds are redeemable at the end instead of 10 lakhs at 15 lakhs. There is a legal and other fees which is incurred, that is a transaction cost incurred at time 0. XYZ determines that market interest rate on 1st January X5 on the date of renegotiations is 11%. This is the market rate of interest on the date of renegotiation. Okay, so I think one thing is pretty clear, that in this case a renegotiation has been done. You sat down with the lender and you said, sir, please reduce the interest from 10 to 5. You said, sir, please extend the period by another 2 years and make it a total tenure of 12 years. You also agreed with him, sir, you please, ask me that I'm going to pay you 15 lakhs at the end of the 12th year instead of paying you 10 lakhs at the end of 10th year. So there has been a change in the interest, there has been a change in the principal, and there is a change in the tenure simultaneously. We need to see that is this a material change or not, and then accordingly accounting would apply. So then he says the repayment schedule for the original debt till the date of renegotiation is given. So what he has done, he has made a payment. It says this is 10 lakhs continuing and there is an interest accrual of 10%. So he's been continuously making a payment in this case. The principal is redeemable after 10 years, bullet shot payment. So this is the interest accrued at the rate of 10% and the cash flow is given. So the closing balance of the loan, the principal loan, continues to be 10 lakh till the end of the 5th year. On 1st January X5, now the solution starts. So I think let's work upon the solution ourselves. Let's work out the 3-step model to decide the kind of accounting. Let's do that. So what are we going to do? I'm going to work out the things out here itself. So I am applying my 10% test in this particular case. This 10% test will decide the fate of the kind of accounting to be applied. Are we applying extinguishment or modification accounting? So we go to the step number 1. In step number 1, you need to calculate the present value of the new cash flows based on original EIR. Now, what is the new cash flow? Since the tenure is now, you renegotiated at the end of the 5th year. So now you got to pay interest at the new rate of 5% for the next 7 years. Because the tenure is extended by 2 years, so you are going to pay interest at the rate of 5%, which means I am going to pay the interest on 10 lakh rupees at the rate of 5% for the next 7 years. So I would discount this at the original EIR. Let's take at 10% a sum total of 7 years factor. So I am going to pay the interest at the rate of 5% for the next 7 years to go. Revised cash flow. plus I will pay 15 lakhs, mind you. Then I'm going to pay another 15 lakhs at the end of the seventh year. So let's get the discounting rate 10% at seventh year end. And I will also be incurring a TC as well. There is a TC of 1 lakh rupee. So there are 3 elements to be taken in step 1. You're going to pay interest for the next 7 years at the rate of 5% new terms. You're going to pay a principal at 15 lakhs at the end of 7th year. And there is a TC which is paid at time 0. Let's see what is the present value of all these cash flows. If somebody could help me with the calculations. So what is the P factor at 10%, 7 years? 1, 2, 3, 4, 5, 6, 7. I think this is 0.513. And I guess this is 4.868 if I am correct. So 10 lakh rupees into 5% into 4.868, 243,400. I guess this is coming to a total of 11 lakh 12,900. This is the present value of all the cash flows on the basis of new terms, including a TC. Then we go to the step number 2. Let me put this step number 2 out here. So now we go to the step number 2, and in terms of the step number 2, we now need to consider the remaining cash flows based on the original terms. So he says on 1st January, after 5 years, you decide the modification. So in terms of step 2, on 10 lakh rupees, you're liable to pay 10% interest for the next 5 years. So let's see the interest for the next 5 years in this case, plus you're also liable to pay this 10 lakh rupees at the end of the 5th year. So let's see the factor at the end of 5th year, that is 5th year end. So this is the cash flows based on original terms discounted at original EIR. So let's see at 5%, 10%, what is the factor? This is 1, 2, 3, 4, 5. This is 0.621 and this is, I think, 3.791. So let's see what is the present value of all these outflows. So 1 lakh into 3.791. And this is 621. This is, I think, coming to 10 lakh rupees approximately. And trust me, this will come 10 lakhs only. Because even if you're considering whatever is the present value of the remaining cash flows at 10%, you're paying interest at 10, you're going to discount at 10. So at the end of the day, the compounding discounting is the same rate. So this is bound to be 10 lakhs only. Then we go to the step number 3 to find out the variation. So we can see the variation is what? The difference between 11 lakh 12,900 minus 10 lakh over the base of 10 lakh. Let's see what is the percentage variation in this case. Because we are making a payment which is based on the new and the old terms. So let's see the variation. 11 lakh 12,900 minus 10 lakh upon 10 lakh, the variation is coming to 11.29%. We're getting a variation of 11.29% in this particular case. So I think with this particular inputs in hand, I am approximately getting the same answer. If you see the workings are done, so they've done the workings and it says the difference is 11.32. I'm quite close, 11.3. So there might be some differences because of decimal placements, but otherwise I'm approximately coming to the same. The variation is 11.32. I'm getting a variation 11.29. Since the materiality test tells me that the variation is more than 10%, 10% or more, extinguishment accounting would apply. And that is the reason it is given extinguishment accounting. The question is not over. This 10% materiality test is only telling you that there is an extinguishment accounting to be done. But what are the entries to be done at this stage? That's what the focus is. So let's have a look. Now let's see further that what is the entry we are going to pass in this particular case. So further moving with this inputs, and let's see the journal entry which I am going to pass at this stage. Extinguishment accounting means that you need to remove the old liability from the books of accounts. So let's see the entry as well. So what we're going to do, the journal entry which we are going to pass in terms of extinguishment accounting, once we've decided on the basis of the 10% test that we are going to apply an extinguishment accounting, let's see how the extinguishment accounting in this particular case would apply. I will recognize a new liability and derecognize the old liability. So the old financial liability will be given a debit and the new financial liability is going to be given a credit. So the old liability will be derecognized from the books of accounts at a book value. And the new liability is not to be taken based on the 3 steps. Because in those cases, you've taken the original EIR for discounting. Now you need the fair value of the new liability at this stage. So this new liability is going to be recorded at the fair value, which is going to be using the interest rate, the market interest rate on the date of renegotiation. I was already given in the question that on 1st January, when you did a renegotiation, the interest rate, the market interest rate is 11%. So what we need to do at this stage, when you are passing the entry, you need to consider the new market rate at 11%. So let's see the cash flows on new terms. So you are liable to pay on 10 lakh rupees a 5% interest for the next 7 years. So let's discount this at 11% for 7 years. And you are going to pay this 15 lakh rupees at the end of the 7th year. The principal repayment is 15 lakhs, which is 10% for a period of 7th years. So we need a discounting at 11%, that is 7th year end. No TC. No TC. Remember the crucial points. When you apply the 3-step model, you are taking the TC in the calculation. But in this case, since it's a renegotiation, the TC is not allowed. The TC is going to be simply credited separately, that is 1 lakh rupee. The TC was allowed earlier to be adjusted in FL, but when you renegotiate, you're actually not paying money to the bankers. In this particular case, I would indirectly penalize you for this behavior. And I'm going to tell you that, boss, your entire transaction cost is immediately expensed off. It is indirectly discouraging them that if you are doing a renegotiation, I will not allow you to adjust it in the FL amount. The renegotiations will mean the financial liability is taken at a fair value without TC. So let's see the factor. So we are taking this at 11%. 1, 2, 3, 4, 5, 6, 7. This is 0.482. And this is 4.712. So we can consider on 10 lakh rupees, 5% into 4.712, 235,600. This is coming to 958,600 is the new liability. So what we have done, derecognize the liability at a book value, recognize the new liability at a fair value, and the TC recorded separately. Let's now see what is the balancing figure. Whatever is the balancing figure in this entry, 58,600, that is going to be taken in the P&L. So we take the balancing figure, profit and loss debit, and this is to the extent of 58,600 is the balancing figure. So we can see the inputs given could be calculations 58097. I'm getting 58,600. Decimals differences could arise. So this is the entry which will be done at the time of renegotiations. The moral of the story. So what are we supposed to do in this particular case? You apply a 3-step model and you decide the kind of accounting. In this case, we applied an extinguishment accounting. So what is the entry for extinguishment accounting? The old liability is derecognized at a book value. The new liability is recorded at a fair value, which is using the interest rate on the date of renegotiations without TC. The TC is taken care separately any balancing figure is a gain or loss arising on extinguishment, and that enters the P&L. Right, friends? I hope I am clear with the picture. Great. Okay, this was extinguishment accounting. Now we need to do another question where we're going to see that a 10% test is applied. You get a percentage below 10, and we need to apply what is called a modification accounting. Interesting. Now, in terms of the modification accounting, it says Index 109 is not clear on the accounting treatment. So there are two alternative approaches which have been suggested under modification accounting. So 109 does not give you a definite accounting when the 10% test fails. In this case, there are two accountings. We'll see the accountings in the practical illustration itself. So we're going to basically apply a second kind of accounting. Let's see the example number 4. I think let's have a look at the example number 4, where we're going to see the 10% test, and then we'll see the modification accounting to be done. It says on 1st January X0, the company issued a 10-year bonds bearing interest at the rate of 10%, which is a contracted rate. And the interest is payable annually each year. The bonds are redeemable on December X9, and there is no cost or fees incurred, no TC, no processing fee. Same question, which means the contracted rate and the effective rate is supposed to be same, considering no premium and discounts can be there for loans. So the effective interest rate is therefore at the rate of 10%, that is the EIR. Then all the data is same. On 1st January, that is 5 years later, the bondholders agree to a modification. No further interest payments are made. The bonds are redeemed at the original due date at 16 lakhs. No extension of period, and the fees paid by the borrower, that is the transaction cost, is 50,000. So this time the renegotiation is in a different format. No interest payments further, only principal repayment, no extension of period, and there is a TC. The repayment schedule for the original debt till the date of renegotiation is given. So they've taken the interest at 10%, the cash flows are paid, so the closing balance continues to be 10 lakh. Let's apply the 3-step model to decide the materiality, whether it is 10 or below 10. Let's see. So let's go back and let's apply the 10% test to begin with. So we're going to apply the 10% test in this case and see the fate. So in terms of the step number 1, we need the new terms. As for the new terms, no interest payment, only one bullet payment of 16 lakhs discounted at the rate of original EIR, which is going to be at the 5th year end. Because you're going to pay this principal at the original rate, original date itself, and there is a TC to the extent of 50,000. So this will give me the present value of all the future outflows. So we need discounting at 10% 5th year, 2, 3, 4, 5. That's 0.6 to 1. So we can get 16 lakhs into 0.6 to 1 plus the TC, that works out at 1043,600. Then you go to the step number 2. And in terms of the step number 2, the present value of remaining original cash flow. And this will come to 10 lakhs only. You've already seen that in the previous example also. It's going to be 10 lakh. So let's see what is the percentage variation in this case. And I think we can clearly see the variation is supposed to be 43,600 by 10 lakhs. It is coming to 4.36%. The variation in this case is below 10%, which means we're applying a modification accounting. So this will lead to a modification accounting. So my 10% test decides the fate that we need to apply a modification accounting. I guess if I look at the percentage computed, it is coming to 4.35 minus coming 4.36, not bad, almost the same. So the 10% test applied is giving me the concept that extinguishment accounting cannot apply, but a modification accounting would apply. No derecognitions of the liability will take place. So let's see what is the inputs given. The accounting treatment to be done, I'll give you the entry. 50,000 TC is netted off against the existing liability. So what we're going to do at this particular stage, the amount which you paid is going to get adjusted against the FL. So the journal entry. Let's see the journal entry. So on the date of renegotiation, what is the journal entry to be done in the books of accounts? Financial liability will be given a debit and bank will be given a credit. This is to the extent of 50,000. That is the transaction cost incurred. See the difference in the treatment. When it was a case of extinguishment accounting, we told the company that you are not paying money of the bankers. Boss, your TC is going to be immediately expensed. But in this case, since the materiality differences is not much, we're giving him the advantage of reducing the TC from the FL. So when the extinguishment accounting applied, the TC was not allowed to be deferred. It was immediately expensed in the P&L. But in this particular case, since it is, materiality factors are not very high, you're telling them that you can adjust. But now the problem is, if you're going to reduce the amount of TC from the financial liability, this will also lead to a change in the accounting, that is the effective interest rate as well. You will no longer be able to apply the concept of 10% because you changed the financial liability figure. So see what the standard makes a suggestion in terms of this. So in terms of this, it says what you need to do further in this particular case is you need to calculate a new effective interest rate in this particular case. Because now you've adjusted the FL, so there is a need to consider a new rate for the unwinding as well. So what is this new rate? The rate is going to be the one where the future inflows of 16 is equal to 950. So if you just try to visualize the picture, we can say your financial liability in the books of accounts is 950. So the payment which you are going to pay at the end of 5 years 16. So what you can do, you can calculate an internal rate of return. Consider this 950 as a cash outflow and consider this 16 lakh as a cash inflow. That's the only inflow. Look at things from the holder's point of view. Look at from the lender's point of view and see that this is like the outflow and he's going to get 16 lakhs inflow. This is the outflow at time 0 and this the inflow at the 5th year end. So calculate the internal rate of return. So when you apply your financial management principles, calculate the internal rate of return, it comes to 10.99%. So you need to see the rate at which the present value of 16 lakhs will equal 9 lakh 50. And then you need to calculate the new EIR so that my subsequent accounting can take place at the 10.99 EIR itself. Then that's what it adds on. The adjusted EIR is used to determine the amortized cost and the interest expense in the future periods to go. So this is what we need to do in this particular case. So once you've taken care of this input, then you can say there is a need to recompute. There is a need to recompute the EIR. And in this particular case, we have calculated that to be 10.99%. And then the further accounting is going to be done. Moral of the story now. I think I just want to make a quick mind map on the derecognition of the financial liability SDR at this particular stage. So let me just make a quick mind map at this particular stage. So I guess I can make a quick recap, a small mind map on the financial liability derecognitions also. My financial assets derecognition done, my financial liability derecognitions done. Wow. So when you're looking at the derecognition of financial liabilities, we're looking at the derecognitions of financial liabilities, I would say, what you need to do, you need to first apply a 10% test, which is I gave you a 3-step model, which I gave you. And we've already documented the three-step model as well. Now, what do you do next? When you apply the three-step model, the test is pass or the test is fail. When I say the test is pass, that means the variation is 10% or more. When you say the test is fail, that means the variation percentage is below 10% in this case. So the test, if it passes, in this particular case, what I need to do, I need to apply what is called an extinguishment accounting. I need to apply what is called an extinguishment accounting. So what is to be done in terms of the extinguishment accounting? You need to derecognize the financial liability. The old financial liability will be given a debit at the book value. The new financial liability is going to be given a credit. The new financial liability is going to be given a credit, which is at the fair value. And when you calculate the fair value, you need to consider the discount rate, which is the market rate. You need to consider the discount rate at the market rate on renegotiation date. So you need to consider what is the market rate of interest on the date of renegotiation. And another inputs you need to keep in mind is that we will take the fair value, but excluding TC. No TC to be taken in this stage. The transaction cost is not allowed to be adjusted to the FL. The TC is going to be recorded separately. The bank gets a credit for the transaction cost. Remember, in this 3 steps, the TC was taken in step number 1. But now it's not going to be taken the fair value. And any balancing figure in this entry is going to be taken in the P&L, the gain or loss arising on extinguishment accounting. Then if it is supposed to be below 8%, below 10% in this case, so we need to apply what is called a modification accounting. What we need to do in this particular case is apply what is called a modification accounting. And in terms of the modification accounting, what you need to do in this particular case, you will put the entry financial liability gets a debit and the bank gets a credit. This is on account of the transaction cost which is incurred. And along with this, what you need to do, plus we need to recalculate. We need to recalculate the effective, the new, I would say, effective interest rate. In order to do the subsequent accounting, you need to recalculate the new effective interest rate as well. Wonderful indeed. So that is the inputs which is done. Great. This is the concept of modification and extinguishment accounting, derecognitions of financial liabilities done. Interesting, superb indeed. I guess, friends, I am pretty clear now with the inputs discussed. So derecognition is done. Now we need to go ahead to the next special issue. There are 3 issues more, as I said: hedge accounting, impairment, and the concept of embedded derivatives as well. So now we're going to go to the inputs in terms of hedge accounting. You want me to discuss impairment first, or you want me to discuss hedge accounting? I'm more interested in hedge accounting. Any preferences at this stage? Ready for the hedge accounting, I think? Yes. Okay. So no preferences at this stage? Great. Then I think let me start the journey. I'm going to first make some inputs to you. Before I give you a break, I want to first make some inputs at this stage and take it further. So let's, I think, take the inputs at this stage. Okay, so I am now going to the next special issue, which is called hedge accounting. The next special issue, what we're discussing is the concept, what is called hedge accounting. Now, this is something, which, people generally have a lot of apprehensions in terms of understanding. There has been an illustration, I guess, not illustration, but there has been a question which came in the RTPs as well. But I think we need to get some good understanding before you can do that particular question. So I think I'll do some questions which I'll do on my own, and you'll be able to do that particular question as well. So let me first give you a little background in terms of what is hedge accounting. Because this is a complicated affair, so I am going to give you again a step-by-step approach. But this time it's not 3 steps. Every time it cannot be 3 steps. I'm going to give you what is a 5-step model. So we're going to follow a 5-step model in terms of hedge accounting. Now, let's first of all understand what is a hedge accounting. I always tell people a very simple example to illustrate the concept of what is hedge. Let's say, for example, it is raining outside. Now, what will I do reasonably? I'll take an umbrella. Now, when I take an umbrella, what am I trying to do? I'm trying to protect myself from rain. But do you think even after using an umbrella, I will not get drenched at all? Of course, I will get drenched. But of course, I'll not get heavily drenched. Taking an umbrella is not a 100% solution. Because even if you take an umbrella, you're still going to drench a bit as well. Maybe if you're lucky, you may not get drenched. Depends upon the size of the umbrella and also depends upon the intensity of the rainfall happening. So basically, hedge is also, we can say, is like a protection. But there is one thing which I would like to tell you, that when people look at hedge accounting, what comes to the mind is that I want to basically reduce a loss. I want to basically mitigate a loss. Not necessary. Hedging can also be used for the purpose of protecting gains as well. So there may be a situation where the financial asset, for example, or any asset for that example, I know that the value of the financial asset has increased, but it's unrealized gain. And I want to ensure that I'm able to protect that unrealized gains as well. So hedging can work under both alternatives. It can be to protect unrealized gains. It can be to protect against the reduction in losses, which can happen, the unrealized losses. It can work both ways. But as far as hedge accounting is concerned, Indus 109 very clearly makes it that it's not mandatory. It is a complete choice on the part of the company whether it wants to conduct a hedge accounting or not. So which means, number one, we need to keep one focus clear, that hedge accounting could be to protect against losses. It could also be to protect the unrealized gains. Second, hedge accounting is not mandatory. It's a complete choice on the part of the company. But once it triggers the choice of applying hedge accounting, then there is a lot of documentations which needs to be done. So let's make some inputs at this stage. So we can say, number one, when I say hedge, so when we say the word hedge, the hedge is basically, you can say to protect. You can say it is to protect. So we can say the idea in terms of hedge is that I want to protect my unrealized gains. I want to protect my unrealized gains, or I need to mitigate. Mitigate means to reduce. I want to mitigate or reduce, you can say, the losses, which is again the unrealized losses. So the idea can be either of the two. Second, as we said, in terms of hedge accounting, this is not mandatory in nature. It is a complete choice on the part of the company. So it is a choice. A company may apply a hedge accounting. It is nowhere mandatory. Now, as I said, in terms of hedge accounting, what I'm going to do, I am going to give you a 5-step model. So let's give you a very basic inputs on the 5-step model before we go for a break. So I am going to give you the 5-step model. We'll work on this 5-step model very soon. So when you apply a hedge accounting, I would say there are a total of 5 steps. The step number 1 is to identify what is called a hedged item. In simple words, I would say a hedge item is something which I want to protect. Like, for example, if it is raining outside, I want to protect myself. So in that example, I would say it's the hedged item. I am the hedged item which I want to protect. That becomes a hedged item, what you want to protect. The second is what is called hedging instrument. The second is what we call hedging instrument. So when I say hedging instrument, I can say it is the tool with which you protect yourself. So in my same example, if I am looking at that I take an umbrella, then I would say the umbrella is the tool with which I'm protecting myself. That is the hedging instrument. So what you want to protect is the hedged item, and the tool with which the protection is done is called the hedging instrument. The third step is what we call a qualifying criteria. In order to apply the concept of hedge accounting, certain criteria are to be met. We'll see those qualifying criteria, but of course, in a practical illustration, we will always assume the criteria is met. So we will assume that yes, the criteria is met, so we don't need to evaluate much, but yes, conceptually we need to know that there is a qualifying criteria. The step number 4 is to decide the type of hedge which we want to use. Well, typically there are three kinds of hedge. One is called a fair value hedge, one is called a cash flow hedge, and one is called a NIFO, that is a net investment in a foreign operation. But of course, from the examination point of view, I'm basically going to discuss two kinds of hedge. One is called a fair value hedge and one is called a cash flow hedge. The management has to decide which kind of hedge are they going to apply. We'll see the detail later. So once you meet the qualifying criteria, you need to zero down on the fact that what is the kind of hedge. And finally, the step number 5 is looking at the accounting of this hedge. That once you zero down that it is a fair value hedge or it is a cash flow hedge, you need to now zero down on the fact that how the accounting is done. So it's a 5-step model which we need to understand. Identify the item to be protected, that is called the hedged item. Identify the tool with which the protection is done, called the hedging instrument. Identify that you met the qualifying criteria of applying a hedge accounting. And identify the type of hedge. Is it a fair value or a cash flow hedge? And then do the accounting in terms of hedge. So that was a very basic introduction to you on the hedge accounting. Time to give you a break now. We are going to work on these 5-step models after the break with you, friends. So I'm going to join you in 10-12 minutes time. Enjoy your break, and I'm going to see you after the break. Okay. I hope you had your relaxation of mind. So I think now let's come back to the agenda. In terms of the hedge accounting, so to quickly remind you, we said it's a 5-step inputs what you need to keep in mind. The first thing you need to identify, what do you want to protect? It's called a hedged item. The tool with which the protection is done, that's called the hedging instrument. And the qualifying criteria is to be met, deciding on the type of the hedge, and then finally doing the accounting. So let's have little inputs now on each of these steps. Let's, I think, have a little detailed inputs on each step. So as I said, we are looking at a 5-step model in terms of hedge accounting. And my very first step, number 1, is what we call hedged item. So let's give you a little more insight in terms of what is a hedged item. The question is, what can I protect? Can I protect only items which are there in the balance sheet? Or can I also protect items which are not in the balance sheet? The answer is a yes. You can protect both. The standard is very clear that an item which you want to protect, that is the hedged item, could be a recognized asset or liability in the balance sheet, or it could be an unrecognized asset or liability. So what do you mean by an unrecognized asset or liability? I think let's give you a little thought of framework now at this stage. So when you're looking at a hedged item, I would say it could be either a recognized asset or liability. So when I say recognize asset or liability, that means it is already appearing in the balance sheet of the company, or it could be something which we can say is an unrecognized asset or liability, which is not in the balance sheet so far. So the question now arises, when you look at an unrecognized asset or liability, I am looking at 2 inputs in terms of unrecognized asset or liability. One is called a firm commitment. Don't worry, I'll explain that. So one is called a firm commitment. And the other one is called, the first is called a firm commitment, and the other one is called highly probable forecasted transaction. Highly probable forecasted transaction. So we'll understand what is this with an example, highly probable forecasted transaction. So let's first understand the difference between a firm commitment and what is called highly probable forecasted transaction. Let's understand this. Let's say, for example, my company is already entered into a contract, let's say to buy a machine at a future date. I've not bought the machine, but I've only entered into the contract where I am planning to buy a machine, but I've already entered into the contract. So when I say it is a firm commitment means in this particular case that you've already entered into a contract. We've already entered into a contract. Since you've already entered into the contract, you are committed to buy. So if you're committed to buy a machinery, for example, the machinery is not in the books of accounts. It's not an asset in the balance sheet. But since there is a commitment to buy that particular asset, you've already entered the contract. It is a firm commitment. But when I say it is a highly probable forecasted transaction, we've not entered into the contract, but it is highly likely that such kind of transaction would occur. So in this particular case, when you say highly probable in nature, we have not yet entered into a contract. We have not yet entered into a contract. But then there are quite high chances of this transaction happening. So which means, let's say, for example, it is forecasted that yes, I am going to buy a machine. So when you say a firm commitment, you've already entered a contract. You've already decided to buy. But when you say it is a probable transaction, which means you have not entered in the contract, but it is highly likely that this transaction could occur. So the asset and liability is not in the balance sheet. So the standard does not make a distinction between, what you want to protect. You want to protect something which is already in the balance sheet of the company. You want to protect something which is not in the balance sheet of the company. You can do that. So that is step number 1. Now let's have a look at the step number 2. Now let's look at the input in terms of step number 2. And step number 2 is what we call hedging instrument. The step number 2 is what we call a hedging instrument. Now, as I said earlier, a hedging instrument is basically the tool with which the protection is done. Generally, I'm saying generally, I'll not get into any kind of exceptions at this stage. So we can say generally, when you look at a hedging instruments, derivatives, a forwards, a futures, or we can say the swap arrangements, options. So these are the kind of instruments with which a hedging is done. So we are saying that when you're looking at hedging instrument, this is a tool with which a protection is done. So this is what you want to protect, and that is the tool with which you want to protect. So this is generally, as I said, derivative contracts in nature. So when you're going to look at a particular question, you'll see that forward, futures, options, and swap arrangements will be entered into. You already know now what is derivative. So I think the first focus in terms of every question is to identify what are you trying to protect. Get the hedged item. Then look at the inputs and see what is the tool with which protection is happening. Get the hedging instrument at that stage. That is step 2. Then further, we go to step number 3. Now, in terms of the step number 3, we say hedging can be applied only when you meet a certain qualifying criteria. The question rises, what is a qualifying criteria? Not every item can be hedged, though I've given you a very extensive list. So the standard requires the company to sit down and see that the hedged item is eligible. The standard requires the company to sit down and identify that it is an eligible hedging instrument. Most importantly, the standard requires you to do a formal documentation of your hedging policy. Why are you hedging? What is your objective of hedging? What kind of strategy you've designed to hedge? There has to be a formal documentation, and trust me, the formal documentation is also important, because once you apply hedge accounting to a particular item, you will see very shortly the normal accounting will get overruled. Let's say, for example, if I am applying hedge accounting to inventory, I'll stop applying Index 2. I'll not consider the inventory at cost or NRV, whichever is less, but I'll start recording the inventory at a fair value. So it is also important for the stakeholders, especially the auditors, to also understand that hedge accounting is being applied. Because the moment it comes under the purview of hedge accounting, the normal measurement principles would be overridden by Index 109. The item in question which is being accounted under a relevant standard will no longer apply. And Index 109 tells you, typically in a fair value hedge, that you need to account it at a fair value. So that formal documentation in terms of the strategy, in terms of what is the objective, is to be documented as well. Nobody will document that. And most importantly, the standard requires you to test the hedge effectiveness as well. Identify that if you're going to apply a hedge accounting, is that going to be something which will achieve results or not? There is no parameters in terms of percentages which is laid down in IFRS or in terms of Index, which tells you that this is the percentage of hedge effectiveness to be met. And when I say hedge effectiveness, you basically need to see the movement in terms of the hedged item. You need to see the movement in terms of hedging instrument and see that you are able to capture the movements. Though if you look at in terms of US gaps, it requires you in terms of AC 815 that you need to get an hedge effectiveness of almost like 80 to 125%. So we're not going to do questions where we're going to check the hedge effectiveness. But as a part of the qualifying criteria, which I will assume for the practical illustrations, the effectiveness is met. So what you need to do in terms of the qualifying criteria, I would say 4 focus points. I would say there will be a total of 4 focus points in terms of the qualifying criteria. First of all, evaluate that you are considering eligible hedged items. You need to first of all evaluate that you are considering eligible hedge item. What you're trying to hedge is within the list of eligible items. Then you also need to consider that you are dealing with eligible derivative instruments. So you are dealing with eligible hedged instruments. The kind of derivative contracts you have entered into are supposed to be in the list of eligible items. You need to go in for a formal documentation. You need to go in for what we call a formal documentation. The formal documentation would explain the strategy. It will explain the strategy of the company. It will explain the objectives in terms of hedge. Why do they want to hedge? What kind of strategy is being developed by the company in order to hedge? And most importantly, as I said, you need to work upon and see that it is effective hedge effectiveness. So hedge effectiveness needs to be achieved, though there is no prescribed percentages in terms of hedge effectiveness. You already know one thing. A gain on a spot market is a loss on a derivative market, and vice versa. We've already seen that in derivative, that they move in opposite direction. If you get a gain in one market, you're bound to get a loss in the derivative market. So I need to, enter into a hedge so that the gain almost offsets the loss, or the loss almost offsets the gain. So hedge effectiveness is to be evaluated. Then comes the step number 4. And in terms of the step number 4, we need to decide the type of hedge. We need to basically decide the type of hedge. And I've already said that there are 2 kinds of hedge which we'll look at. One is called a fair value hedge, though there are 3, but we're focusing on 2. One is called a fair value hedge, and one is called a cash flow hedge. Now the question rises, which hedge is used in which circumstances? Well, it depends upon a lot on the management perception. There is a possibility that in a given situation, a particular management wants a fair value hedge. But in a particular situation, the same situation, another management wants a cash flow hedge. And in a practical life scenario, it can be challenging as well. But from the examination point of view, you will be very clearly given that which hedge is to be applied. Because as I said, that in a given situation, 2 managements may have a different perception. One would like to hedge on the basis of fair value, another may like to hedge on the basis of cash flow. So it all is a management perception. So this is also, as I would say, dependent upon the management perception as well. What the management wants could be a deciding factor. And finally, once you have zeroed down in terms of the type of hedge, then comes the step number 5. And in terms of the step number 5, you need to decide the accounting of this hedge. That's what my focus point is now. So I think these 4 steps is not going to be a very big task for me in a question, because I'll easily read and identify this is the hedged item, this is the hedging instrument. Okay, I assume the qualifying criteria is met. The question tells me the kind of hedge. My focus is mainly in terms of deciding the accounting. So let's, I think, take you to the accounting. I'll first explain the accounting for a fair value hedge, and then I'll explain you the accounting for a cash flow hedge. So let's go to the fair value hedge to begin with. So let's see how the accounting for a fair value hedge is going to apply. The focus is on the accounting. And trust me, the fair value hedge accounting is pretty simple and pretty straight indeed. There is no complications at all. Now, what do we need to do in terms of the fair value hedge is very simple indeed. You need to identify the hedged item, and you need to identify the hedging instrument, which is derivative. Now, the basic thumb rule, the hedged item will be taken at FVTPL. The hedging instrument will be taken at FVTPL, which means the fair value changes will be captured in the profit and loss. As I said a little earlier, that if you bring any item under the purview of the hedging item, the normal standard will not apply. If you've got a PPE to be hedged, Index 16 will not apply. You no longer carry the asset at a cost model or at a revaluation model, but fair value changes in the P&L, not OCI. So the standard is very clear that whether the hedged item is there, it is going to be taken at FPTPL. The hedging instrument is concerned, it is FPTPL. Which means one thing which is to be clearly mentioned, we can say the normal standards, the normal measurement principle, the normal measurement principles applicable to the item, the normal, you can say, measurement principles applicable to the hedged item will be overridden. They will be overridden by Index 109. So we'll stop applying the principles of the normal standards in this case. Inventory no longer Index 2, PPE no longer Index 16. You're not going to apply the normal standards. In this case, they will be overridden by Index 109. You're going to consider at a fair value only. But there is a little exception. And there is only one exception which is given in the standard, which is a very interesting exception. And the interesting exception which is given in the standard is, the exception which is given in the standard is that if a company is got, let's say, equity investments, which is measured at FPTOCI with a no recycling. Now watch this carefully. You'll find this very interesting indeed. Remember, in terms of equity investments at FPTOCI NR, realized gains and losses were also taken in OCI. The fair value changes were taken in OCI. The realized gains or losses was also taken in OCI because we did not want anything to enter the P&L. I made a statement also at that time, and I said, you'll see even in terms of impairment later, I will not touch the equity investments at OCI. I will not even conduct impairment testing on them. Which means that if you've got equity investments measured at FPTOCI NR, you will continue to do the same accounting. Even if you bring that investment under the purview of hedge accounting, it will continue to be so. No FPTPL. So this is the only exception where we can say that if you've got equity investments, you continue the accounting as FPTOCI. No FPTPL would apply. And the interesting part is that if this exception applies, if this is applicable, that means you are saying I'm hedging the equity investments. If this is applicable, then even here you will follow FPTOCINR. Wonderful. The fair value changes of the hedged item and the fair value changes of the hedging instruments both will be taken in OCI. So moral of the story is that the fair value hedge is very simple. Once you decide a fair value hedge, the fair value changes of the hedged item, the fair value changes of the hedging instruments, all at PTPL. But if there is only one exception, that if your hedged item is equity investments at OCI NR, the fair value changes of the equity investments, the fair value changes of the derivative instruments are going to be taken in FPT OCI. That's it. So we just need to see how will you capture the fair value changes. We'll take a simple example to illustrate the example how the fair value accounting is done. So I'm just going to take one simple example of my own to illustrate you the concept of how the fair value accounting is done. Let's give you a simple example. So we'll just take a very simple little example out here. Just give me a second. I'll just give you a small little example. So let's take a very simple example on a fair value hedge. I'll just give you the inputs. Just have a look at this simple example. This is an example which I am taking on a fair value hedge. Let's give you some basic data. So I'm given, for example, a company on, let's say, 1st January X8. They made a purchase on 1st January X8. They made a purchase of, let's say, equity investments. and it was supposed to be measured at FPTOCI. It is measured at FPTOCI, that is no recycling. Equity investments, we've already seen, is always at NR. Now let's say on 30th September, so this was purchased, let's say, at the rate of 9 lakh rupees. This was the cost at which the investment is purchased. So let's say on 30th September, X8, if you look at the fair value of this investment, it is still continues to be 9 lakhs itself. No changes in the fair value. But in this particular case, let's say, for example, I am assuming that, this is a case of a fair value hedge. That's what I'm assuming. Now let's consider on the balance sheet date, that is on December X8. So the company on 30th September, let's say, entered into, let's say, a futures contract. So what they did in order to hedge, they entered into a futures contract to sell futures. They entered into a futures contract to sell the futures, and let's say at the rate of 9 lakhs itself. So they entered into a derivative contract on 30th September. And then this is my balance sheet date. Now let's give you the status on the balance sheet date. Let's say the fair value of the equity instruments is gone down. So let's say the fair value of this equity instruments went down to 8 lakhs. And let's say the fair value of the futures is increased by 90. So there is, let's say, there is a change to the extent of 90,000. I'll put it as a change. There is a change to the extent of 90,000. So just giving you very basic data that you have got some equity investments at FPTOCI, which was bought at the rate of 9 lakhs. On 30th September, the management became apprehensive that they are seeing that the fair value might fall down. Though it was 9 lakhs on 30th September, but they entered into a derivative contract on that date. And on the balance sheet date, the status of the fair value changes of the item and the instrument is given. Now let's apply the 5-step model to get the inputs. Let's see the walkthrough in terms of the 5-step model. My step number 1. If I ask myself a question, what is the hedged item? I would say it is a recognized asset. It is an equity investments. So in this particular case, my equity investments is supposed to be the hedged item in this particular case. Then I go to the step number 2 and ask myself a question that what is the hedging instrument? I would say you entered into a derivative contract futures. So the futures which you've entered into is supposed to be a hedging instrument. I go to the step number 3 and I look at whether a qualifying criteria is met. I have not given it the status, but I am assuming that yes, the criteria is met. I'm assuming that, let's say, the criteria is met, hedge effectiveness is there, eligible items, eligible instruments, everything is done, documentation is done, so the criteria is met. I go to the step number 4 and I give you that we are applying a fair value hedge in this case. So what I need to do in terms of the step number 5 is decide an accounting at this stage. Very simple accounting as well. I would now say that, okay, you need to follow FPTPL, but this is an exception. So the fair value changes on the hedged item OCI, fair value changes on the hedging instrument derivative OCI, simple. So in this particular case, there is a fall in terms of the equity investment. So if there is a fall in equity investments, so for the hedged item, I'll put an entry, OCI gets a debit and the equity investment gets a credit. So there is a fall of 1 lakh rupee. The fair value changes are entered in the other comprehensive income at this particular stage. And then if you look at the hedging instrument in this particular case, the derivative instrument as well, what you can do, in this particular case, a loss on the item means a gain on the derivative instrument, because we've already seen that if you get a gain in the spot market, you get a loss on the derivative market and vice versa. So the loss in this particular case is compensated by a gain. So what we're going to do in this particular case, call it as a financial asset. I'm putting D, derivative. Let's create a separate account, a derivative financial asset, and we're going to give a credit to other comprehensive income. This is to the extent of 90,000. So what happens in this case, when you capture the fair value changes in the OCI, the net impact in terms of OCI is just 10,000. And imagine, just do understand the bit. Let's say if the company would not have entered into a hedging instrument as a derivative. So what would have happened? To this hedged item, you would have applied FPT OCI. And to the hedging instrument, you would have applied the concept of FPTPL. Because derivative would have been accounted under FPTPL. So if the company would not have applied hedge accounting, they would have captured the fair value changes of the equity investments in OCI. They would have considered the fair value changes on the derivative instruments in terms of P&L, and that would not offset the things. Because one fair value change goes in P&L, another one in the OCI, not giving you an offsetting advantage. But the moment you designated this instrument to be for hedge purposes, the fair value changes in both cases enters OCI, gives you an offsetting advantage as well. So this is as simple as the concept of a fair value hedge is concerned. Put the fair value changes as a thumb rule in terms of the P&L. With the exceptions of equity investments at OCI, put them in the OCI, and even the derivative instrument changes in the OCI. I hope, friends, that is pretty clear, simple and straight. No complications on the fair value hedge, right? Okay, now I think let's come to the accounting in terms of the cash flow hedge. Now let's see the accounting which will happen in terms of a cash flow hedge. Now this can become a complicated affair. Because fair value hedge is not at all complicated, it's pretty simple and straight, but cash flow hedge can be of concerns. So please hear me carefully, because after one understands a fair value hedge, suddenly when you come to cash flow hedge, you say, no, I'm not able to understand that. So see this. Watch this carefully. I'll take examples also to illustrate the concept, but just watch this carefully. So let's say I'm looking at an hedged item and I'm looking at a hedging instrument. So I'm looking at the hedged item and I'm looking at the hedging instrument. Let's see how the accounting will be done. When a company decides a cash flow hedge, remember one thing, your hedged item is accounted in a normal way. If you've got inventory, Index 2 continues. If you've got a PPE, Index 16 continues. So no fair value accounting applies to the hedged item. So as far as the hedged item is concerned, you can say the normal accounting continues. In case the normal accounting continues, you don't need to do any fair value accounting. So no fair value accounting is to be done, unlike a fair value hedge. Get this straight. If it is a fair value hedge, you started accounting at FPTPL. In this case, no FPTPL. A normal accounting will continue. So you will apply the relevant standards in this case. You will apply the relevant standards in this case. Nothing is to be done separately. The relevant standards keep continuing. That's one. Now, in this particular case, here you will capture the fair value changes. You will capture the fair value changes. Now these fair value changes will be taken in the OCI and it may be taken in terms of P&L. The fair value changes are going to be taken in terms of OCI and in terms of P&L. Now watch this carefully. I'll give you the logic also very soon. But right now, understand the concept, in the sense, understand the procedure. We'll understand the concept as well, the logic. But first, let's understand the procedure. So we will compute the fair value changes. Some portion will be captured in the OCI and some portion will be in the P&L. So what do we do? So we can say what goes in the OCI is something what we call the effective portion. What enters in the OCI is called the effective portion, and what enters in the P&L is called the ineffective portion. So we need to split the fair value changes in terms of two elements. What is the fair value change, which is called effective? Now you say, how do you identify what is effective? Nobody will see that. But any effective portion will go in the OCI and the ineffective portion will go in the P&L. Now, how do you decide what is effective and what is ineffective in nature? Watch this. In order to decide what is effective and ineffective, you are going to follow a simple concept. Let's see the steps which I am going to apply. Let's see the steps I'm going to apply. And I'm going to give you a three-step model in terms of deciding what is the effective and ineffective. We'll see the logic later, but first let's see the inputs. What are you going to do in terms of step number one? You will calculate the fair value change of hedged item. You heard me correct. I will calculate the fair value of the hedged item, sir, but you said that I will not account this item at a fair value. Then why are you computing? I'm computing, I'm not accounting. The hedged item will continue at a normal accounting. I will just calculate the fair value change of the hedged item. Let's say this comes to, let's say A. Let's say this value comes to A. And then in step number two, I will calculate the fair value change of hedging instrument. I will calculate the fair value change of the hedging instrument. Let's call this as B. So we will calculate the fair value change of the item, we'll calculate the fair value change of the instrument A and B. Then what I'll do, I'll compare A and B. I'll compare the fair value changes, that is A versus B. We'll compare the two. Now there could be a lot of permutation combinations. Either A is greater than B or A is less than B. So there will be two permutations combinations. So let's see what is to be done in this case. So in this particular case, we can say that let's say if A is supposed to be greater than B, or let's say if A is less than B, then what is the course of action? Now watch this carefully. So the fair value change of the hedged item is more than the fair value change of the hedging instrument. I will transfer B. I will transfer B in OCI. I'm not accounting for A. So what will I do? I will transfer the B amount, whatever is the fair value change of the hedging instrument, this will be transferred to OCI. It is called effective portion. We say the hedge is effective. So why? Don't worry, we'll understand that. So in this particular case, we will transfer B to the other comprehensive income. The fair value change of the hedging instrument will be transferred in the OCI, calling it as an effective hedge. And when A is less than B, the B value is greater. So what I will do, I will transfer A to OCI, considering it to be effective portion. And I will transfer B minus A. I will transfer B minus A to the profit and loss, calling it as an ineffective portion. Sir, you rightly said, sir, after discussing this, we understood fair value hedge. But this is going above the head. Don't worry, I will give you the logic as well. First, understand, appreciate the procedure. The logic will be given. Let's, I think, first again, understand the procedure. Then I will give you the logic as well. So now you need to keep in mind that our focus is on a cash flow hedge. When the focus is on a cash flow hedge, you need to remember the hedged item continues with the normal accounting. No fair value changes are captured. No fair value changes are captured. You will only capture the fair value changes of the hedging instrument. You will only capture the fair value changes of the hedging instrument in this particular case. And the fair value changes of the hedging instruments will be captured in the OCI or P&L, depending what is effective and what is ineffective. Indirectly, when you say that you're going to take it in the OCI, it is effective portion, and what goes in the P&L is an ineffective portion. So how do we decide what is effective and what is ineffective in nature is decided with the help of a three-step model. And in terms of the three-step model, you will calculate the fair value changes of the hedged item, 1. You will calculate the fair value changes of the hedging instrument, 2. and compare the changes in the fair value A versus B. If A is supposed to be greater than B, if A is supposed to be greater than B, then we are only accounting for B, because we are only accounting for the fair value changes of the hedging instrument. Entire B will go in the OCI, calling it effective. And if A is supposed to be less than B, then I'll transfer A, the lesser figure, in the OCI effective, and the difference in B minus A, ineffective portion, in the P&L. So now tell us the logic. Very simple logic. What is the hedging instrument? It's like the umbrella which I took on the rain. Remember? When I took at the hedging instrument, I'm looking at the umbrella which I took in the rain. Now, when you say A is greater than B, your umbrella is small. Your umbrella is small. Please hear this carefully. When I say A is greater than B, your umbrella is small. If you got a smaller umbrella, it's okay. Because in that particular case, you're not over hedging. So I will say whatever is the fair value changes can enter in the OCI. But in this particular case, when the B is more than A, in that case, your umbrella is bigger. You're not allowed to carry the bigger umbrella. The rain is happening small and you want to enter into derivative contracts and take a bigger size of umbrella, more than the size of umbrella you require. So you're overhedging. If you're overhedging, then I'll give you normal accounting, FPTPL. So therefore, only to the extent of the size, your umbrella size should have been equal to A. If your umbrella size would have been equal to A is the effective portion, the excess bigger umbrella. The excess, that is bigger umbrella, is smartness. That smartness ineffective will go in the P&L. So the standard setters were very clear that in terms of the accounting of a cash flow hedge, you need to capture the fair value changes of the hedging instrument, segregate the effective, ineffective. So when the fair value change of the hedging instrument is less, your umbrella size is good, OCI. Remember it like this. When the fair value of the hedging instrument is greater, you've got a bigger umbrella size. So to the extent of A, which is the appropriate size of the umbrella, goes in OCI. The excess umbrella goes in the P&L, ineffective portion. I hope, friends, I made sense. Right? Now, let's give you another inputs also at this particular stage. Don't worry, we'll do a practical illustrations also, understanding how do we apply these differences, etc. Now, when you say that it is taken in the OCI, I think it is worth important to remind you that what enters in the OCI is going to be taken in SOCI as well. Because whatever fair value changes will be captured in the OCI is going to be captured in the tab 3 of SOCI. So this amount is going to be accumulated. This amount is going to be accumulated in, you can say, the tab 3 of statement of changes in equity, SOCI. So you're going to put this amount in the tab 3 of SOCI and you're going to give it a name. And you're going to give it a name, and that's going to be called as CFHR, cash flow hedge reserve. So the amount which you will capture in terms of the fair value changes in OCI gets accumulated in the tab 3 of SOCI, and this is going to be called as CFHR. This is called cash flow. This is called cash flow hedge reserve. The other question which also comes into the mind is, what are you going to do with this CFHR? Is it R or is it NR? It is R. This will be reclassified in the profit and loss account when the hedged item will impact the P&L. Sir, what did you say? Don't worry, we'll see that later. So this amount which is accumulated in the tab 3 under the name cash flow hedge reserve is going to be reclassified in the P&L when the hedged item impacts the income statement. So this is going to be OCI-R. So I would also like to make a mention quick at this particular stage that this cash flow hedge reserve is going to be reclassified. It is going to be reclassified to profit and loss account when the hedged item impacts, you can say, the income statement, when it impacts the profit and loss account. How would the hedged item impact the profit and loss? Let's give you a flavor for that as well. Let's say, for example, inventory is the hedged item. Let's say, for example, if inventory is the hedged item, when would the inventory hit the income statement? When it is sold. So if you have entered into a cash flow hedge to hedge the inventory, the fair value changes in terms of the derivative instruments are captured in the OCI, tab number 3, CFHR. So that accumulated amount in terms of the CFHR will be put in the P&L when the inventory is sold. So when you go to sell the inventory, I'm going to put that fair value, accumulated fair value changes of the derivative instruments into the P&L at that stage. But let's say, for example, if the hedged item is, let's say, a plant and machinery, then when does a plant and machinery enter the income statement? When it is depreciated. But sir, it won't be depreciated in one go. It is going to be depreciated over a period of time. No worry. Then I will transfer the CFHR to the P&L every year when the depreciations on the machineries are taken. So this amount in CFHR could be a one-time transfer in terms of P&L, or it could be staggered over a period of time. But once it is staggered, it is basically adjusted against the hedge item. I may not make sense what I'm speaking at this stage without an example. In fact, if I would have got time enough, I would have taken 2 examples with you where I would have explained one example when the entire amount in CFHR goes in the P&L in one go. And the other one is that you would have transferred the CFHR adjusted to the hedged item. Maybe I will explain that, the other illustration, but I want to definitely do one illustration with you, not at this stage. But I'll do one illustration, of course, giving you a little inputs as well. So moral of the story, I think I need to first get a question, getting this comparison very clear. So first thing, what I need to, summarize before I go further. First, we'll do a question. Then I'll summarize the inputs in terms of accounting for a fair value and a cash flow hedge, because you need to get the basics very clear. That what happens on the accounting front. Let's first take a small example on a cash flow hedge. So let's give you a small example on a cash flow hedge. Let's see the 3-step model, how the 3-step model is to be applied. So let's give you a small example in this case. Let me consider that there is a hedged item, and let me consider there is an hedging instrument. I'm looking at a cash flow hedge, so watch me very carefully. I'll give you 2 permutations, combinations to understand the broader concept with figures so we get the entire picture clear. So let's consider, first of all, the fair value change of the hedged item. I'm given the fair value change of the hedged item is 9100. Are you going to account for it? No. Let's get the position very clear. Are you going to do account for it? The answer is no. I'm not going to account for 9100, just a computation. We are not accounting for this 9100. It is only captured to compare later. It's not accounted for. Let's say the fair value changes out here. Let's say the fair value change out here is, let's say, to the extent of 8500. So are you going to account for this particular item? Yes. Now let's get it very straight. Please watch this example very carefully. So I am saying that you are accounting only for the fair value changes of the hedging instrument. Now, let me first of all see, is your umbrella size bigger or not? It should not be big. The basic input is your umbrella size should not be big. I cannot allow you to carry on a bigger umbrella. So is your umbrella size big or small? It is small. It is either equal or less. I'm okay. So in this particular case, you compare 8500 versus 9100, and therefore we conclude that it is an effective hedge. Umbrella size is okay. How do you compare? When you compare this, umbrella size is fine. Umbrella size is fine means it is effective hedge. If it is effective hedge, then this 8,500 is going to be transferred to other comprehensive income under the head CFHR. CFHR in terms of tab number 3 in terms of SOKI. Simple and straight. So we're going to basically put this 8,500 is the effective portion, and the effective portion is accumulated in tab 3 of SOKI, OCI, and that is OCI-R, recycling. Let's take another example as well. Let's consider the same. The fair value changes is 9,100. And let's consider a different figure. The fair value changes in this case, let's say, consider a figure of 10,000. Let's consider 10,000 in this case. Let's get the funda again very clear. Are you going to account for the fair value changes in this case? No. Are you going to account for the fair value changes in this case? Yes. You're going to account for 10,000. You're going to account for 10,000. So you compare the umbrella size. You compare the umbrella and see, are you carrying a bigger umbrella? This is 9,100. You're carrying a bigger umbrella. I don't like it. Why is the umbrella size bigger? The excess umbrella size is ineffective. So you compare the figure of 10,000 versus 9,100, that 900 difference, excess umbrella. That is something which is ineffective. So what do? Your umbrella size should be maximum 9,100 or less. So what I'll do in this particular case, out of this 9,100, we will say it is the effective portion. Out of this 9,100 is the effective portion which enters in the other comprehensive income recycling. Because your umbrella size should be maximum of 9,100, so that 9,100 is effective size of the umbrella. And the excess 900, this is the excess, the difference. This is what we call is the ineffective portion, and the ineffective portion is going to be taken in the profit and loss immediately. This is the concept of a fair value and a cash flow hedge. You got the larger picture clear. How do you capture the fair value changes? We'll do a little comprehensive question as well, but first I want to do a little mapping at this stage. Let me do a little mapping at this stage. 900 goes to P&L. That is absolutely correct. So I think you've all got a basic feel of how the accounting is done. So moral of the story, let me just make a quick mind map at this particular stage. I am just going to create a simple mind map at this particular stage to get the fundas clear. So we are now looking at a thing so that everything is very crystal clear, because sometimes a confusion can crop in. So I want to get the comparatives clear. So watch this chart very carefully. So my focus is in terms of the fair value hedge. My focus is in terms of the cash flow hedge. So my focus is in terms of the cash flow hedge. Now let's see the comparative position to get it very clear. So I am looking at number one, the hedged item. I'm looking at number one, the hedged item. I'm looking at number two, the hedging instrument. I'm looking at the hedging instrument. So my focus point is the hedged item and in terms of hedging instrument. So what do? In this particular case, when it is a fair value hedge, will you capture the item? Yes, FPTPL. Fair value changes, P&L. Are you going to capture the fair value changes again, P&L? Yes. We're going to capture the fair value changes in both cases, exception, equity investments, OCI. So we can say there is only one exception, and the exception is if you've got equity investments, at FPT OCI, that is NR, in that particular case, both goes OCI. Life is simple. Fair value changes hedge item P&L. Fair value changes hedging instrument P&L. Simple. With the only exception which is there. Now let's come to the concept of a cash flow hedge. In this particular case, the hedge item is usual accounting. It is usual accounting. Your normal accounting continues. You don't need to capture the hedged item at any fair value. You've got inventory, continue index 2. You've got PPE, continues index 16. You've got intangible investment property, continue 3840, whatever the case may be. So usual accounting continued, no fair value changes captured. No fair value changes are captured. This is one important differences which you need to get this clear in the mind. No fair value changes will be captured. In this particular case, what do? We need to capture the fair value change. We need to capture the fair value change in this case. And you need to apply a three-step model to decide the fair value change capturing. So in this particular case, what you need to do, once you say the fair value changes are to be captured, you need to apply a three-step model which I gave you. So you will compare the fair value changes and then decide the picture. The three-step model will basically tell you what is the effective portion and what is the ineffective portion. And you know the criteria in terms of deciding the effective, ineffective. You compare fair value changes of the item and the instrument, write the words item and the instrument to get the effective and the ineffective portions. The effective portions are taken in the other comprehensive income from where they are taken in CFHR, which is supposed to be in the statement of changes in equity, as we said, tab 3. And the ineffective portions are supposed to be taken in the P&L immediately. And I've already given you the inputs as well, that whatever is in the CFHR is going to be accumulated in tab 3 and it will definitely go to the P&L one day, but not necessarily in a P&L, not necessarily always in a P&L. So let's, I think, give you a slight little inputs at this particular stage. I'll just like to give you a little inputs at this stage. I may not be able to give you 100% clarity this stage without an example, but I want to take a risk. I want to give you a little more inputs at this stage. So let me just talk a little more on this on SOKI. Now in this particular case, watch this carefully. I'm looking at SOKI. I'm looking at the SOKI. So this is my statement of changes in equity. And if you recall, I had always given you that SOKI is got practically a total of 3 tabs. The tab number 1 I've given you earlier is the equity component of CFI. The tab number 2 is basically the reserve and surplus, retained earnings, premiums, etc. And the tab 3 is supposed to be other comprehensive income. So you've got a tab number 1, you've got a tab number 2, and you've got a tab 3, and I want to focus now in terms of tab 3, CFHR, the cash flow hedge reserve. Now watch this carefully, friends. If you've got an accumulated amount, in terms of the CFHR, so you've got an accumulated amount in terms of CFHR. You know, we've already seen the amount in tab 3 goes in the tab 2 directly, indirectly. You know the concept of R and R. You've seen that. So in this particular case, I would say there are 2 treatments. There is number 1. It may get transferred to tab 2 indirectly. It may get transferred to the tab 2 indirectly. Indirectly means rooted in the P&L, because when you're looking at the CFHR, it is basically with a reclassification. So it will enter the tab number 2 indirectly, because you'll put the accumulated amount in P&L and it will enter the tab number 2 indirectly, not directly, but rooting in the P&L, it comes indirectly. But let me pinpoint one thing very important at this stage. This indirectly transferred could be in one go, or it could be over a period of time. It could be over a period of time. Let me explain that. Let me explain that. If you're looking at, let's say, an inventory, if you're looking at, let's say, an inventory, the moment you sell the inventory, the accumulated OCI will go entirely in the P&L in one go the day it is sold. Hear this carefully. When you say that the hedged item is inventory, so one fine day you sell the item because that was the hedged item. When you sell the item, it goes entirely in the P&L. So in this particular case, one go could be when the hedged item is inventory. When the hedged item is supposed to be inventory, you will transfer it in one go on sale. So when you sell the inventory, you will transfer the entire amount in the P&L in one go. But if you say that it is over a period of time, it's over a period of time. Now imagine. Let's say the hedged item is a machinery. If the hedged item is a machinery, you will not put the machinery in a P&L in one go, but you will transfer the P&L depreciation slowly, steadily. So what I will do, I will transfer this amount. Hear this carefully. I will transfer this accumulated amount not in P&L, not in tab 2, but I will adjust the hedged item. So this accumulated amount will be adjusted. This will be adjusted against the hedged item. It will be adjusted against the hedge item so that automatically it will enter the P&L. Sir, automatically enter the P&L in the sense, if there is a machinery which you purchased, if you purchase a machinery, you would adjust the machinery along with the CFHR. So if your hedged item is a machinery, I will increase the machinery. So once the accumulated CFHR is there, I will transfer the entire amount in the machinery account, adjusted in the PPE. So once the PPE goes up and down, it'll automatically change the depreciations over a period of time. So you need to be watchful and careful, and this is what we technically call as a basis adjustment. It is called a basis adjustment. I know, without looking at a question, it is difficult to make so much of a visualization what is happening. It is a complicated affair. So I will do a practical illustration with you, but I'll take only one example, because if I take two examples, I will not get enough time. So I will take one examples in terms of inventory, but then through the inventory, I will illustrate the inputs. So the basic thought process is that the amount accumulated in CFHR either goes in the P&L or gets adjusted to the hedged item. Please hear me carefully. I'm saying the accumulated amount in the OCI will either enter the P&L in one go or will be adjusted against the hedged item so that it gets impacted slowly and steadily later. Because the hedged item, once it enters the P&L, only the CFHR can then hit the P&L. So once you adjust the amount in the PPE value will increase or decrease, and depreciation will accordingly increase or decrease, and indirectly that CFHR will enter the P&L in the form of increased or decreased depreciations, as the case may be. I don't know if I made much sense on that, but I know without a practical illustration, it is difficult to understand that bit as well. Anyway. So moral of the story, I have given you theoretically the clarity on a cash flow hedge. I will do a practical illustration with you tomorrow itself. Then I need to touch upon the concept of impairment. And I also need to give you an accounting in terms of ED, that is embedded derivative as well. So I've got three agendas, most complicated bit tomorrow. I need to give you an accounting in terms of a cash flow hedge. A complicated accounting. I need to discuss the concept of impairments with you, which is again a bit complicated part. And I need to give you the accounting in terms of embedded derivative. Tomorrow we will finish with the concept of financial instruments. Tomorrow is the last class in terms of financial instruments. Thereafter, we're going to start a journey in terms of consolidations, which is going to start before the year ends. And then the major portion happens in the next year. Right, friends. Absolutely clear. That's wonderful indeed. Thank you very much indeed. Any questions on your end, friends, you can ask me. Otherwise, we're done for the day. And do remember, once you're doing your revisions, please do a cumulative revisions now for all the 10 classes put together before the year comes to an end. Practice all the questions from the study material, from the RTPs and the past examination questions. Get yourself strong. Because I think there has been a lot of new questions also added in the study material as well for the May 25 exams and all. So you must look at them. I think if I'm rightly clear, I think there are almost like 100+ questions added in terms of study material for the May 25 one as well. So please check out the website of ICAI for the new questions as well. Clear indeed. That's wonderful indeed, friends. So I think that's all for the day. Thank you very much indeed. So I'll see you tomorrow at the same time, friends. Thank you very much indeed. Bye. Yes.
Just here to say thank you.
Okay, thank you so much.
I'm just clear too. You look
Oh,
so
Raj Gurane, oh, wonderful. I saw your message yesterday on LinkedIn as well. That was feeling so proud to see your message and felt very good indeed. That's so beautiful that you've just joined the class today to thank as well. Wonderful indeed. I wish you the best for your coming futures as well.
thank you.
I must tell everybody that Raj Gurani has, just joined in. He is a qualified chartered accountant, and he's attributed, a lot of his inputs taken from the ICI live classes he has attended. I could see the message very, very clearly mentioned that he studied majorly from the ICI classes, free resources, a good initiative board studies. Thank you, Raj Gurani. Congrats once again to you, your family, and blessed good future ahead.
Thank you, sir.
Thank you. Thank you very much indeed. Thank you. Bye-bye and take care. Haji, thank you.